Hey guys, it's Max Convexity. Thanks for tuning into the show. I appreciate you guys being here. This is the Daily Covered Caller, Friday edition. Let's see what's on the agenda for today. I don't think I shared that. I have to remember to share the screen, right? Before I sit back and, okay. Okay, we'll look at the ETF heat map, see what's moving. We'll look at Apple earnings. We'll take a look at the buffer report. We'll take a look at the Defiance trades, the Yield Max trades, the Tesla crash Delta neutral trade, and the New Year's baby trade, which is doing really well today. The market is selling off. So unfortunately, but I didn't want to be right about the market being down. But anyway, all right. So let's check the heat map. Maybe it'll bounce. Maybe I am wrong. Maybe this is the last of it, and then it'll go up from here. I don't know. Okay. Well, look at this. Triple Q's down 3%, and they were down more than 3% yesterday, I believe. That's, a lot of damage there at tech. Only things that are up are inverse NASDAQ and government bonds, actually. Earlier, Bitcoin was up, but it's turned around and it's down. Some of the Bitcoins, some grayscale, these were all green a little while ago, less than an hour ago. All right, so onto the Apple earnings trade. All I wanted to say about it was a big success. I did some content on an Apple pre-earnings trade and also on a Meta pre-earnings trade. And the Meta one's up $1,400 on about $700 worth of risk right now. The Apple one's up $353 on $800 worth of risk right now. This is an example of when something goes right on an earnings trade. This is the way I like to play them, these double diagonals. When something goes wrong, it's going to look like this. Don't always get them right. When something goes wrong, it's going to look like Amazon's. It's a max loss, down 335. It actually could have lost 350, but anyway, it went the other way. So you can't win them all. Anyway, okay, so let's go and look at some the buffer report. All right, the buffer report is kind of early in the day for the buffer report, but let's see what's moving in the index high yield land. Well, as you can see, the only thing moving up was government bonds. The TLTW is a high yield, semi-high yield covered call fund that runs covered call, synthetic covered call strategy, or maybe a regular covered call strategy on the TLT. Anyway, TLT's up big today, 2.5 points. So TLTW is actually also up, not as big, about a third as much though. Nice job though. Really the only thing that's up today in the indexes. All right, the standouts on the bad side are iSpy, and iSpy was also outperforming on the downside yesterday. FEPI, KQQQ, SVOL are all outperforming the benchmark on the downside, as is ULTY and as is IWMY. Oh my gosh, it's a bad day. And as is THTA. Look at THTA getting killed. Boy, THTA doesn't lose that much very often. That's a very safe strategy. They do, I'll do a video on it, but they do basically iron condors. But when iron condors go wrong, they go really wrong. And I think that's what's happening today. All right, well, I'm not a big iron condor fan. You don't ever see me talking about iron condors. Okay, so let's see what else we can look at. Okay, the Defiance trades are going to be ugly. Let's look real quick. All right, so here's the long and short of it. They sold options for $227, which is a shitload. It's the second most they've ever received, but right now it would cost $628 to cover those options here with 4 hours left of the day, 4.5 hours, something like that. So down 4.8 million right now. Triple QY is down 51 cents a share. The good news is the dividend estimate's at $1.28. Of course, is capturing all this premium. That's what happens. That, that's part of the buffer that the covered call strategy creates. All right, so JPY, it's going to be the same story. They sold options for $45, which is even more than 2 days ago when they only got 44. Unfortunately, those options would cost $160 to buy back right now, so that's creating a $2.3 million loss and a 41-cent a share loss on the month. Good news is the dividend estimate is at 91 cents. They're killing it. And wait till you see IWMY's dividend estimate at $1.30. Wow. These guys sold options for $31, and right now they have to buy them back for $111. It's a $4.9 million loser. And this fund's only $137 million assets under management. Well, now it's more like 133, or, subtract 4.9 from 137, 132. Anyway. All right. Well, it's negative 62 cents on the month. Dividend estimate, like I say, $1.30. Okay. So let's look at USOY. Now, USOY, the yellow line's the option they have open. They have the 78 put open 1,600 times. They sold it for $1.22. All right. Well, right now USO is at 72.94. So this one has a big loss as well. Well, let's just figure it out. Let's figure it out. So say 4, so 5, so 6, so 7, so 8. Jeez. These guys are sitting on a gigantic loss, and their other trades have been winners this month, but it would bring USOI to 50 cents a share negative. Dividend estimates $1.40. So same story on all of them. Okay. So now let's look at the Tesla crash delta neutral trade, because we're going to go over to the yield max side of the equation. So today, crash's price is 16.05. It's up 1.58%. Tesla, unfortunately, is down 3.86%. So if you're playing the pair, you're down the difference, 2.26%. Right now, since inception, this pairs trade is down 9%. However, it's yielded 13% so far in just 2 months. So anyway, the pairs trade is where you buy Tesla and crash together in equal weightings, and play it and trade it as a pair. Think of it as one underlying. You weight it as you would one underlying. It's just one position. It's one high yield position. You could have a position in JEPQ, then you could have a position in the Tesla crash pairs trade. And to me, they should be the same allocation. Anyway, that's just me. All right, so talk to your financial planner. They won't let you buy Tesla, which is fine. Financial planners don't like these stocks. All right. All right, well, so let's go to the chart and let's see what's happening on the chart. So the problem with this trade, and the reason this pairs trade is losing money, it loses money whenever the price of Tesla jumps the fence, and it jumps through one of the strike prices, which is what it's done here. And it's jumped through the bearish strike. So that means the bearish ETF, which is crash, is capped out right now. But the bullish ETF is still losing, because they do the bullish does a synthetic cover call strategy, right? Well, a cover call strategy loses pretty much unlimited on the downside. It's not a hedge. It's hedged by the premium of the call, which may be like 0.5% or something. So, but it's not, if you have a big down market, cover call strategies are shit. So, well, the good news is they don't do as bad as the underlying does. A cover call strategy on Tesla won't do as bad as Tesla without a cover call will do in a down market. So anyway, it's just a matter of perspective. All right. Matter if you need the income also. All right. So that's Tesla. Let's look at the other. This is Coney and Fiat. They have an inverse fund, and this one's jumped the freaking fence too really bad. I honestly didn't check, and I don't know that maybe these guys didn't roll out yesterday. I doubt they did, but in any event, this pairs trade, I don't have the spreadsheet built yet, but you can bet this pairs trade is losing money today. The bearish side, which is Fiat, is now capped out because the covered puts they were writing, even though that's great to write covered puts, once it jumps the strike price, boom, capped out. So they don't get any more appreciation from the NAV. they're still collecting a little bit of time decay, but they would have got the time decay anyway. They get the time decay no matter what. So this is not ideal. Now let's look at NVIDIA. They have an inverse also. It's called dips. I didn't draw the profit boxes out far enough, but in any event, this one's jumped the fence a little bit too. Same thing though. I don't have a spreadsheet on it, but I can guarantee you people that are playing this pair are losing right now. And this is a brand new, this is the first week it started. So let's also look at MSTY, Misty. Underline is Mr. MicroStrategies. They have a two strike ladder way out here. The cover call portion's doing great, but their NAV is doing bad. So what happens, these funds, they're down 1.8%. Their covered calls are collecting time decay, just like they always do, though. They're doing their job. So let's look at AMD. AMD selling off pretty bad today, but it's actually bounced today. It's selling off lately, but it's up 2.6%. It's actually bouncing today. Wow. Let's see if NVIDIA is not bouncing with it, though. NVIDIA is showing down 2%. And I know Intel's getting killed because I did an earnings trade on it, and it was a max loser. Yeah. Gosh darn it. When earnings trades go wrong, right here, $550 debit, and it's going to lose pretty much all of it. It's done. It's max loss. It's cushioned a little bit by this $1,400 winner on Facebook or Meta. This is about as good as it gets. You're trying to land it here between these two strikes. This is your max profit. So this is what happens when earnings trades go right, but Intel's what happens when they go wrong. So, all right. So let's look at, let's see what else we should look at. All right. Well, so back to options land. Let's look at the New Year's baby trade. Market selling off today. Yeah, gosh darn it. This is 48,000. It was up 27,000 yesterday. This trade made 20,000 overnight. Now, they cost $32,000 to put on, but it protects you for, well, half of July, but August, September, October, November, December, 5.5 months. Anyway, protects $1 million portfolio. What it does is it gives $1 million portfolio a get out of jail free card. So if this person has margin or whatever, the option position is designed to be up exactly as much as the $1 million portfolio that was in SPY that's in growth, let's say, should be down. So since this trade came on, let's see how it's working. Let's do a real quick audit of it right here. Okay, so let's check the numbers here. So right there, July 10th. So July 10th, and it was, I'm trying to think, it was an SPX hedge. So we need to look at the SPX. It was not a NASDAQ hedge. But July 10th was, I got the top pretty close. Here's July 10th right here. And actually the close on July 10th was up here. I was trying to sell that close. I figured that might be the all-time high or the high for a couple of months. Looks like I got pretty close so far. We'll see, but you know, but anyway, so that's the market was at 5,600 right there. Now the market's at 5,300, just round terms. So 300 point drop on, so call it 6%. So it's a 6% pullback. So if you had $1 million portfolio before, you would have, you would be down $60,000. Well, unfortunately, the $1 million baby at this point is only up 42,000, or actually is up a little bit less than that. Well, it's up 49,000 actually at this point. But it, you know, you've lost about $10,000 more. But if the selling picks up, the way this is designed, and just the way all hedges are designed with puts have convexity. and that is if the market sells off, volatility increases. Volatility is one of the inputs in the equation for the option prices. And so when you're using a hedge with puts and you're long the puts, you own the puts, then the volatility increasing helps you. And so that's what I expect will happen. Volatility will bump if this keeps dropping. And then if it drops another 10% from here, let's say, that would be a 16% totally down on the market. So this trade should have 160,000 paid back. That's what 16% of $1 million would be. And right here, it would have it paid back. And that's even if it happens soon. Well, it'd have 156 of it paid back. But if it takes like a few more months to drop another 10%, then it would still be covered. The longer it goes, the more. But also, even if it dropped another 20% from here, it's a total get out of jail free card. Now, the only catch is if the market's still down New Year's Eve, what you're hoping for when you do this, or what I'm hoping for, is that it just protects you, but then the market rallies and you never have to cash it in because it's a huge tax bill. But if the market drops in October, November, then we have the Santa Claus rally, and it rallies back up here, and you're basically unchanged or whatever, and you didn't have to do anything with this, and so you bought it for 30,000, and maybe you sell it for 30,000 if the market stays about the same or whatever. That's fine too, because you didn't get a margin call on the way down. You weren't sweating it. You were totally covered the whole way down. But the opposite of that is if it does, New Year's Eve comes and we're still down, 20% from here. And remember, we're down 6% from where I put the trade on. So that's 26% total, and it's New Year. Well, and it's New Year's Eve. So we'll roll the time forward. Here's Christmas Eve. Anyway, so here's with about a week to go. If we're down 26% from where we put on the trade, it'd be $250,000 damage in your average $1 million portfolio. Well, this is up 326. Part of that's because of the convexity, but part of that's just structurally the way I built it in. Anyway, these trades are great. If anyone's interested, it's not too late to put on a trade like this. It would have been better to put it on 3 weeks ago when I started talking about it, but maybe I'll make some content with the new one, because some time's passed, but also volatility's popped. So I'll see what it would cost to put on a new get out of jail free card type trade for the end of the year. I just don't see a lot of good stuff happening between here and there. However, here's the other thing though, in the short term, and it might bounce from here. This might be a good trade like for next Friday buy calls or something. Yeah, we might have a face ripping rally. I'm not saying that, but I think generally that July 10th was the high for a while. It's the way that I structured the trade and the way I'm playing it. Anyway, let me know if you guys are interested in stuff like that. I like to talk about that. Anyway, if you weren't interested in it, hopefully you've turned off the video a long time ago. So, all right, guys, well, I appreciate it. I'll be back at the end of the day today. And because the market's really selling off fast, we'll do an end of the day update. Right now it's bouncing. We have a long way to bounce if we're going to get back into the money, but I mean, it could happen. But this big open gap here, it gap past the prior low. I mean, that's super bearish, especially if it doesn't fill that gap by the end of the day. I mean, anyway. All right. So I appreciate you guys being here. All right. See you later.